Hello, powerful people. Millen Livis is here, your holistic financial independence mentor. Welcome to part 2 of the mini training series, Investing in the Stock Market Using Index Funds. I see many money coaches promote investing in the stock market using index funds. As I shared with you in part 1 of this mini training series, the main reason some people choose to invest using index funds are the passive nature and relatively low cost of this kind of investing. That's why IRA and 401k accounts, retirement accounts, offer options to invest in index funds. If you missed part 1 training of this series, you can catch up with it on my YouTube channel. And here's the link to this, Millen Livis Channel Well. Look, while index fund investing has its merits, if you want to take a broad and passive approach to your investment portfolio, there are many reasons, and I'll share with you top 5 of these reasons today, why it may not be the best way to achieve your investment goals. All right, so we're going to talk about 5 reasons to avoid index funds today. The reason number 1 is lack of downside protection. Over the long term, the stock market has proved to be a great investment. However, all financial markets go through bumps and bruises periods. We're witnessing a very bumpy phase in the stock market right now. Investing in index funds, for example, in the fund that tracks S&P 500 index, will give you the upside when the market is going up, but it will leave you completely vulnerable to the downside when markets crash or go through correction. Remember, index funds are mutual funds, and you cannot place a stop loss order or a trailing stop order, which would trigger a sell of a stock to limit your losses on a certain stock positions if you hold individual stocks. In other words, limit orders do not apply to the trading of mutual funds. So you kind of stuck with your index fund position unless you decide to sell it manually. All right. Okay, so let's continue to reason number 2 not to invest in index funds is lack of ability to adjust asset allocation. Index investing does not allow for asset allocation adjustments. One of the risk management tools is not to invest in any specific stock position more than 5% of your overall portfolio value. If a particular stock in a fund becomes overvalued, it actually starts to carry more weight in the index, increasing your portfolio exposure to that particular stock, right? And high exposure often leads to high risk. So even if you have a clear idea of a stock that is overvalued or undervalued, if you invest through index funds, you will not be able to make adjustments in this portfolio, in the index fund, because you will not be able to act on this knowledge because you buy in the fund as a whole, right? Shares of this fund. You're not adjusting any particular stocks in this fund. All right, reason number 3, no control over index funds holdings. I actually kind of alluded to this right now. Index funds are created as basket of stocks that are included in some market indexes, right? Like I gave the example of S&P 500 index. When investors buy an index fund, they have no control over individual stocks in the portfolio. You may have specific companies that you like and you want to own, and you may have other companies that you could care less about. For example, you may dislike some companies in the index fund for maybe moral or personal reasons, right? It could be these companies could have issues with the way they treat the environment, or with the way they manage the employees, or the products that they make, whatever these reasons might be. The components of index funds are out of your control. All right. All right. Next is reason number 4 not to invest in index funds would be limited exposure to different strategies. There are various strategies that you can use to invest in the stock market. Unfortunately, buying an index fund doesn't give you access to a lot of these strategies. Yes, index funds investing will give you diversification, but that can also be achieved with as few as 10 or 20 stocks or even less, right? Instead of 500 stocks that comprise of S&P 500 index that it tracks. If you do a bit of research yourself or subscribe to good research letters, you may be able to find the best value stocks, the best growth stocks, and the best dividend paying stocks, and use other investing strategies. And based on your research, you can combine your stocks into a smaller, more targeted portfolio that is better positioned than the overall market, and portfolio that better suited for your personal goals and, frankly, your risk tolerance. Because different investing strategies can be combined to provide investors with better risk-adjusted returns. All right, next is number 5 is the reason not to invest using index funds is diminished personal satisfaction. Frankly, investing can be worrisome and stressful, especially during the times of market turmoil like we experience right now. It's true that selecting specific stocks may leave you constantly checking quotes and can keep you awake at night. Personally, I don't experience that. I like to invest in individual funds. For me, it's like going shopping, right? So with this being said, investing in index funds will not ease your worries that market will correct. It will not. You can still find yourself constantly checking on the stock market and feeling worried about losing money. On top of this, you will diminish the satisfaction and excitement of making good investment decisions and being successful with your money. For me, this satisfaction is very important. All right. The bottom line of today's training. While index investing is a popular investment strategy, there are reasons why some investors, myself included, might not choose this strategy, might not choose to invest using index funds. Although index funds may be low cost and diversified form of investing, they prevent seizing some great investment opportunities because you basically stuck with whatever companies are part of particular index. And finally, index funds investing does not provide protection from market corrections and crashes, as I shared with you earlier. All right, that's all I have for part 2 of this mini training series. Join me next week for part 3, not part 1, for part 3, where I will talk about costs of investing using index funds. Because remember, that's one of the reasons people like to invest in index funds, because of the low cost. So we'll talk about cost of investing in using index funds. And if you want to discuss your financial goals and investing strategies with me, book your Never Worry About Money Again consultation at speakwithmillen.com. Spots are limited, so if you're interested, make sure that you do that. We will uncover your financial roadblocks. We will strategize how to remove them and how to make your money work for you. All right, stay blessed, stay in your power to your health, wealth, and freedom.